Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Liquid alternatives, perhaps that's a term you have heard. Sounds fancy. It promises to be a hedge fund technique that could be used in mutual funds. Doesn't that sound nice? Hedge fund returns, but in a safe and liquid vehicle like a mutual fund. Well, that's a promise. Pete Hecht of Evanston Capital Management will help us understand that promise, help us to recast that promise analytically, ask the correct questions. Mr. Hecht, before joining the private sector, was a professor of finance at Harvard University. So that's liquid alternatives, and that's in a few minutes. But first, let's talk about huge businesses and their interactions with powerful national governments. I moved to talk about this because last weekend's Wall Street Journal, that's March 5th, 6th, 2016, there was an entire page of seemingly random stories, but they really had one theme, and that's the one I just uttered, which is the relationship between huge businesses and powerful national governments. One was about Monsanto and the government of India. I call it facing off with the elephant. This is an example of just straight up conflict. Monsanto sells genetically modified crop technology in India through a joint venture. In fact, I did not know this, but 97% of India's cotton fields grow genetically modified cotton, modified to have bug-killing proteins. One hopes that leads to less pesticide use. Anyway, the government maintains that Monsanto is charging too much money, and under antitrust principles has imposed price controls on Monsanto in India. Monsanto is now threatening to withdraw from India, take its modified crop technology out of India. So the condition for Monsanto continuing its business the way it has been is reaching some deal with the government whereby it pays more or charges less, rather. Secondly, and I call this one riding the dragon, Adidas in China. Adidas, the shoe manufacturer, and of course other sporting equipment manufacturer, depends heavily on China for its growth. And I was impressed that Adidas is going to expand by 3,000 stores nationwide in China. That's a lot of stores. Adidas is positioning itself to take advantage of China's government's desire to make itself a national, or I should say an international soccer power, to host and win a World Cup. China has been bringing in star players from Europe to help the effort. And Adidas has signed a deal with the government of China to help create soccer programs in 20,000 elementary and middle schools all around China. Well, okay. So Adidas will be 3,000 stores in, 20,000 programs in, and desperately needs China for its growth. Well, what the dragon gives, the dragon takes away. That is certainly a theme in the China we know over the last 20 years. When the time comes, the dragon will get what it wants from Adidas. I'm sure they're ready for it. It should be interesting to see. Well, that's India and China, less developed economies. Surely it's not like that in the Western world. Well, in the UK, the government won. I call this one paying off the lion. Facebook had legally structured itself in the United Kingdom to minimize its taxes. The UK government does not like that. Foreign companies minimizing taxes throughout the EU has been a cause célèbre. When a government doesn't like what you're doing with taxes, there's an implicit threat that the government will change the tax laws, will investigate, will use other levers against your corporate entity. Facebook understands that. So it changed its legal structure to pay taxes to a different legal structure to pay taxes, such that it will pay more in taxes. Congratulations, United Kingdom. Now, these last two are in the US, and I call them running to uncle. We all know that steel prices have been low. They've also been rising a little bit more recently to gain some ground back. But when they got low enough, companies that perceived that they had been hurt by Chinese imports ran to uncle, to the United States Department of Commerce, to initiate a new investigation. And it has initiated a new investigation of Chinese steelmakers with a view toward raising import tariffs on Chinese steel. AK Steel, Nucor, US Steel, ArcelorMittal have been looking for this and are cheering the results. Query: if that is the result, and if the higher prices for steel preserve 10,000 steel-making jobs, how many jobs are lost because steel prices have been risen in industries that use the steel? We see the steel jobs that are saved. We do not see the non-steel jobs that are lost when other companies have to cut back their payroll to accommodate the higher prices. I haven't seen the analysis. I don't know where this falls in this case, but it's almost never the lead paragraph of any story you're going to read about companies running to uncle. So the last of the 5 stories on the page in the Wall Street Journal, I also call running to uncle, has to do with a Canadian entity. You think the Chinese are bad. Well, here come the Canadians. Canadian Pacific Railway Limited seeks to purchase Norfolk Southern Corporation, 2 large railroads, one to buy the other. Of course, raises antitrust concerns. And of course, a Senate panel on antitrust must review this. Sit back. Who benefits from this review? Certainly not those 2 railway companies, because the deal will have to be changed, presumably, to make it less rich for Norfolk Southern, the one that's being bought. Their shareholders will get less money. Meanwhile, Canadian Pacific Railway will get less of what it was seeking to get through the deal. We'll have to pay more. But who benefits from this review? The article tells us FedEx and UPS, 2 companies which probably can look after themselves, but are looking to use uncle to help mitigate potential rises in shipping costs due to the Canadians taking over that railroad. What's my point? Not to ring the anti-government bell, rather to point out that this is business operating at least one remove from the capitalist model we've been taught about in the schools. This is not simply giving the customer what the customer wants through a free exchange, or what Deidre McCloskey, the University of Illinois at Chicago economist, calls trade-tested betterment, and to which she credits the growth in per capita wealth since 1800 of 30 times. Well, it's a different world. Anyway, my point was, the companies on that page of the Wall Street Journal have things to worry about other than just pleasing their customers and shareholders. They've got powerful central governments to deal with, and not just today, but always. Well, let's move from operating businesses that are removed from free exchange to operating reality at a remove from reality. There's a publication called Road to VR online, www.roadtovr. That's Road to Virtual Reality is what the VR stands for. And it reports on a new product by Intel. The name of the article is Intel Developing an AR Headset Using RealSense, report suggests. Article by Paul James, March 7, 2016, on the Road to VR website. What's AR? AR is augmented reality. Augmented reality is distinguished from virtual reality in the following way. Virtual reality is the replacement of reality by a series of images created by, well, computer graphics, to use a broad term, digital graphics, so that you put on your headset and now you're in the 4th century, you're riding around with the Vandals. At least that's what I'd be doing if I had a headset maybe other people are doing other things. Augmented reality is a more mixed reality. Same thing, a headset or helmet, a visor or goggles. But information is superimposed in that situation. Images are superimposed on a view of the real world shown through the glass. So you're getting a view of reality that is augmented. In the old days, we might call that having rose-colored glasses. That refers, of course, to an emotional state in which somebody estimates their chances at happiness or a good outcome at being much higher than they are, usually leading to something harmful down the road. But no, this is augmented reality. Augmented is simply better. We all know that, right? Augmented. You hear augmentation in one context, which is physical augmentation to attract those people you wish to attract for coupling purposes, or physical augmentation to help maintain one's status as an A-list movie star. Augmentation is just simply better. Well, maybe it's not, but the reality is it's very popular. It's going to get more popular the cheaper it gets. And now we're talking about augmented reality headsets. I suppose the day will come, not too long from now, when you're walking down a city street, it's nighttime, people are spilling a little bit out of bars, are coming out. And now you'll see two youngsters, 20-somethings, gazing at one another in public, clearly en amour, or in a more gentle phrase, perhaps, twitcher-pated, certainly looking at each other with intent. And these days you might hear some wag walking by saying, "Get a room." That's going to sound old-fashioned very soon, because the wag is going to walk by and say, "Get some headsets." Let's get to the interview. Now, hedge fund managers make a lot of money because they are paid handsome fees by institutional investors and other big investors to do something special with their invested funds. Could the strategies used by hedge fund managers, for which they are so amply rewarded, become available in vehicles in which accredited investors can invest, much smaller investors? And by contrast to the hedge funds, could such vehicles offer accredited investors daily liquidity? So you get all the good parts of being a hedge fund investor without the bad parts. But that is a perhaps overstated version of the promise of liquid alternatives. And we're going to talk about liquid alternatives today with Pete Hecht. Pete Hecht joined with Evanston Capital Management in 2013. Mr. Hecht previously served in portfolio manager and strategy roles for Allstate Corporation's $35 billion property and casualty insurance portfolio and its $4 billion pension plan. Mr. Hecht also served at investment banks, J.P. Morgan and Hambrecht and Quist, and as consultant for State Street Global Markets. Mr. Hecht was Professor Hecht, an assistant professor of finance at Harvard Business School. And he has research publications covering a variety of areas within finance, including behavioral and rational theories of asset pricing, liquidity, capital market efficiency, complex security valuation, credit risk, and asset allocation. He frequently writes popular columns, and they're very good, I'll tell you, for Institutional Investor and Pension and Investments, which are both online publications, as well as other online publications, taking up discrete questions of investing and finance and helping us see behind these slogans. If you are an economics geek and know the names Fama, Constantinides, Moskowitz, and Thaler, well, so does Mr. Hecht, for each of these professors sat on his dissertation committee. Thank you, Pete Hecht, for being with us today.
Thank you for having me.
All right. So in your popular writings, you help us peer behind slogans, you illuminate jargon. I particularly like your pieces on alpha and beta. I think they're on pension and investments, so I'd like to commend the audience to that. Just search for his name and those words. But today we're going to focus on liquid alternatives. They sound exotic, they're liquid, they're alternative. Pete, what are these things?
So I think there's a lot of definitions out there. The way I like to think of them is pretty much anything besides traditional long-only public stock and bond strategies. And they also have to be housed in a daily priced, a daily liquid mutual fund or exchange-traded fund like an ETF. Some folks like to add in a definition and tie it back to low correlation. I don't like that definition because I think some of the strategies actually don't meet the objective of low correlation. I would say one high-level thing about liquid alts, because some people could respond to my answer and say, well, you're basically defining it as anything but long-only stock and bond strategies, and it sort of is what it is. And I tell people saying liquid alts is about as detailed as saying the word food as the answer to the question of what did you have for dinner last night. It's really broad, it's really general, and I think most people have in mind hedge fund type strategies.
Hedge fund type strategies, but where you can get your money out.
Correct. So you can think of a liquid alt in contrast to maybe a traditional hedge fund is the fact that it's in a daily mutual fund, means you can put in money and take out money on a daily basis. Some other characteristics of a liquid alternative versus a standard hedge fund: there's usually lower investment minimums. There's usually more transparency because of the regulatory framework behind a strategy within a mutual fund. Fees tend to be lower than the types of fees you would experience in a traditional hedge fund product. Those are some other characteristics of a liquid alternative hedge fund strategy versus a traditional hedge fund.
Well, then that raises the question for me, if the liquid alts have high liquidity and hedge funds very often or almost never have high liquidity, what is it the hedge funds get out of low liquidity that you're not going to be able to get the benefit from through a liquid alt?
Well, that brings up like a very important, deep question. So first, let's separate two types of liquidity. One is the liquidity of the investment structure that you happen to be invested in. A mutual fund, contractually, it happens to be daily. Let's say a traditional hedge fund tends to be in a private limited partnership, which, for example, let's say has quarterly liquidity. You can only get out once a quarter. That's the liquidity of the investment structure. Then we need to ask ourselves, what is the liquidity of the actual assets being bought in that strategy? So large cap stocks are very liquid. Distressed junk bonds are very illiquid. And it's important when you're looking to make an investment, whether it's a liquid alternative, whether it's a private hedge fund, whether it's anything, that the liquidity of the investment structure matches the liquidity of the underlying assets in that structure. And the reason why that's important is you don't want a situation where Chris wants his money out of the fund, and so does a bunch of other people, and the manager has no ability to sell the assets to meet the redemptions because the underlying assets are too illiquid relative to the liquidity rights he gave to his investors. And that's something that is critical. And so the implications of that, one is, as an investor, you need to think about that before you invest in anything. The second thing is, when you think of liquid alternatives, if done properly, given that liquid alternatives are in daily mutual fund or ETF structures, you can really only have access to those hedge fund strategies that trade very liquid securities in order to have a proper match between the investment structure, contractual liquidity, and the underlying asset liquidity. And so that means you're probably not going to have access to a distressed credit strategy in a liquid alt form because a manager would never be able to sell distressed credit in 1 day's notice. In fact, if you ever one thing I can tell you, investments is really difficult. But if you ever come across a standalone distressed credit strategy in a daily mutual fund, run, because that is a classic case of a mismatch. So you're going to end up only with those hedge fund strategies that are naturally very liquid, or you should only end up with those, and that's going to be long-short equity. That's going to be global macro, which tends to trade very liquid equity and fixed income derivatives. It's going to include stuff like trend following, which also trades very liquid futures contracts on stock and bond indices and currencies. So when you approach liquid alts, you should just come in with the expectation that you can only potentially have access to the most liquid versions of traditional hedge fund strategies.
Well, indeed, the mutual funds are inhibited by something called the Investment Company Act of 1940, and the SEC takes a dim view of violations of that, too much leverage or assets which lack liquidity. So beware of promises and make sure you understand the assets and relation they would have to daily liquidity in a given vehicle.
One thing, Chris, just if I could just interrupt, just to, something just came to mind as a real life example. A couple of months ago, there was a high profile junk bond mutual fund that experienced a lot of redemption. So it was a daily mutual fund, and a bunch of investors got nervous at the same time. And they all started putting in redemptions, and the fund basically had to throw up their hands and say, "Uncle, I can't meet the redemptions," and they had to gate the fund. So gating the fund means I'm going to suspend redemptions, and they basically are now slowly unwinding the fund, and that's a perfect example. It's like a real example. This is not theoretical, where a strategy that you sort of looks liquid as long as markets are normal, but once there's a negative shock, once there's bad news out there and it scares investors and investors start running for the door, that's not necessarily going to be a problem for a truly liquid strategy. But it was a huge problem for this junk bond fund, this high yield bond fund, and they basically had to shut down. And that's something that's a real risk out there that you need to think about.
I do remember that. Alas, I cannot remember the name of it. Well, okay, that's liquidity, getting your money out, which one should know before one puts the money in. But the function of liquid alts in a given portfolio isn't necessarily to goose the returns upward. There might be other functions for it. Could you comment on that?
So liquid liquid hedge fund strategies, they're very diverse. They could be seen as a diversifier, something that's intended use is to lower the overall volatility of your portfolio. There are some other strategies that are meant to be, and people would bucket them as sort of return enhancers. But the thing I would say to anybody who's investing in a liquid alternative, whether it's for risk reduction reasons or return enhancing reasons, is it goes back to the same framework. Whenever you look at a return stream, whether it's from a liquid alts strategy or a long only active equity strategy or any return stream, you need to figure out what part of that return stream is generic, common, easily available and accessible at Vanguard or some other type of passive management shop, like general market exposure to stock market. You also need to figure out what part of the return is truly special, what part of the return is truly differentiated. Some people call that alpha. I might call it special sauce. And at the end of the day, whether it's a liquid alt strategy that's trying to reduce risk or enhance return, if that strategy, once you do that type of return decomposition, understanding the manager's source of his return, If there's no special sauce left, if it can all be accounted for, what you could have recreated yourself at Vanguard, that strategy, that product should not exist. And I think that's an important lesson, that you're truly looking for something differentiated. You need to be able to measure that, though. You can't just take the manager's word for it. And you want that differentiated return to be positive on average and meaningful. Because I always tell people, Chris, my 5-year-old daughter can give you a differentiated return, but you should never include her in your portfolio. And so the reason for that is, while my daughter might provide an uncorrelated return stream based on her random stock picks, long and short, her return on average, once you control for the Vanguard market exposure, is going to be zero. So that's something that I think is really important when facing off against liquid alternatives or any type of active strategy. You need to have a robust process in place to understand that.
Along those lines, something we discussed before going on the air, we live in a fortunate time, one would say paradoxically, because we've had such misfortune lately. In other words, it's not clear to somebody who's been active in the market in recent years that it always goes up. It doesn't always go up. It can go down and go down quickly. So there's downside risk in the overall market at a given time. And so people might want to invest in a way that inhibits downside risk. And you and I were talking about how there are strategies which introduce some short plays within the strategy to help hedge downside risk. But you had a more elegant way for doing that, and perhaps even getting to the same point, if you'll recall.
Sure. So let's take a long-short equity strategy. Now, a long-short equity strategy, by consistent with its name, goes long stocks and goes short stocks too. Okay, so that means the short stocks sort of act as a hedge. So let's do an example. I'm long $100 worth of stocks, and I'm short $50 worth of stocks. So I really only have $50 of market risk, because I have $100 of longs minus $50 of shorts. So that long-short equity manager is providing me sort of dampened exposure to the stock market. When you make an investment in that long-short equity manager, you're not getting full market exposure like you would if you put $100 in the Vanguard S&P 500 fund. So a lot of people find long-short equity strategies like the one I described is really attractive because it has that dampened volatility type of feature. Now I step back and say, hold on here. That is not a reason to invest in a long-short equity strategy, because you, Mr. and Mrs. Accredited Investor, retail investor, whoever you are, you can recreate that easily on your own. How, Pete? Well, instead of investing $100 in the Vanguard S&P 500 fund, you could just invest $50 in the S&P 500 fund and $50 in cash. That strategy, which is so simple, also has half the stock market exposure, just like the long-short equity strategy I defined. And some people in the investment world will say both of those strategies have a beta of 0.5, representing 0.5 is 50% market exposure. The only reason to go with the long-short equity manager, it's not for that 0.5 exposure, because you can get that elsewhere. That's Walmart. That's Target. You do it because you think that manager has stock picking skill such that above and beyond that 50% market exposure he's going to deliver to you that you can get elsewhere, he is going to add a bunch of special sauce on top of it. What special sauce? A bunch of positive average return. If you don't think that's going to happen, net of fees, then you shouldn't be in that long-short equity manager. And that's the way I think about it. You always have to put on the hat, the opportunity cost hat. What is my alternative? What's my next best alternative? In a lot of these strategies in liquid alt land, there is an alternative at Vanguard or at BlackRock or at some other financial institution. Now, that doesn't mean you shouldn't do the liquid alt. It just means when you're trying to make that judgment call, you always have to think about what's the value proposition. And the value proposition is always measured versus your next best alternative.
Well, yes. And in addition to that, you stepped around the issue of fees. After all, you're going to be paying the manager to be doing something, which means you're going to be paying the manager something. I suppose they must vary fees by the different sorts of management required for a given strategy, but what kinds of fees are we talking about in these liquid alts?
Yeah, so liquid alt fees can be all over the place. I would say on average, let's put it somewhere around 1.5% to, maybe on the higher end, 2%, even above 2%. And there's some that are on the lower end because there's so many different flavors of liquid alts. And that doesn't mean they're better values because it might be a more simple strategy that is deserving of a lower fee. So you always want to, it's just like when I said at the beginning and I said, I had food for dinner. Well, if you want to figure out if the food was overpriced or not, you sort of need to know a little bit more. Was it Chilean sea bass or was it, chicken of the sea tuna? So it's important to keep that in mind. But you should think of liquid alts having fees, a flat fee, a management fee based on AUM of about, on average, 1.5%, which is much lower than a typical full fee private hedge fund structure, which has, let's say, a management fee of closer to 2%, somewhere between 1.5% and 2%, plus a performance fee. So a traditional hedge fund has a performance fee. What's a performance fee? The hedge fund manager takes a percent of the profit. So that means if he generates 10% return for you and he has a 20% performance fee, he's going to take 20% of that 10%, which is another 2%. So people are attracted to liquid alts because they tend to have lower fees than their private counterparts, but you always have to control for quality, right? Yeah, that's very important.
And the fee should be less than the alpha.
Exactly.
Yeah.
Exactly. If it turns out, if you underwrite a manager's strategy and you're like, yeah, I think he has or she has some special sauce there, before thinking about real life frictions like fees, and you're saying, I think they only have about 2% alpha, that means then net of fees, they're going to probably give you close to zero. Fees are really important to think about. But you also need to think about the quality of the underlying manager, because if it turns out that the actual alpha, so let's do an example. Someone says, well, this liquid alt has a much lower fee. It's 1%. But if their gross of fee before fee alpha is 0, then their net of fee alpha is minus 1%. It's 0 minus the 1% fee. Now let's take another manager who charges 2% fee, and his gross of fee alpha is 3%. Well, his net of fee alpha, the alpha that the actual end investor will get, will be 3% minus 2%, which is 1%, which is better than the minus 1 from the other the other manager. So it's just important to really think about the quality issue when trying to determine if you're getting value from a particular manager. And it is not easy to assess quality. It's not like you get to read a prospectus and there's a box that says, check this box if you're a high quality manager, check this box if you're a mediocre, manager, and check this box if you're a bad manager. They all claim to be high quality. That's the problem. They all claim to be high quality, and you as the investor or your advisor have to spend a significant amount of resources, time and money, underwriting all of those managers to figure out which box you need to check with them. Are they a good manager, a mediocre manager, or a bad manager? And the reality is, once you adjust for fees, once you do the proper beta adjustment or that sort of Vanguard opportunity cost example, most managers have nothing to offer.
Oh, dear. Well, and I guess we have an additional difficulty perhaps with liquid alternatives in that the liquid alternatives market has grown maybe 3 times over the last 5 years, from a very small number to a respectable $500 billion annually. So the track record within the liquid alternatives world would be fairly short. Would you agree with that? That's true, that obviously adds difficulty to evaluating a manager.
Exactly. That makes the ability to assess a manager's true skill even that much harder. Now, to be fair, whenever you're assessing a manager's skill, it's both quantitative and it's qualitative. This just means because there's short track records for managers, there's not going to be as much evidence on the quantitative front. And it's going to be a subjective call. And that's why I always try to just tell people like some guiding principles. Like, you know what? I don't believe markets are perfectly efficient, but they're not crazy inefficient, or they're at least not crazy inefficient in really predictable ways. There's not a lot of easy money to be had. And as a result, that's why I always face off against managers or any new strategy with just a healthy dose of skepticism, right? And I always tell people, you know, I already talked about my 5-year-old daughter offering a differentiated return stream. You know, I always give people the example, since I have 2 daughters, and now let me introduce my 8-year-old daughter, Tara. Let's pretend I am a global macro strategy, and as I said before, that's a strategy that tries to time markets. Should I be long equity? Should I be short equity? Should I be long bonds or short bonds? These guys are market timers. And let's just focus on stock market. So I tell my 5-year-old Zoe to be short. She told me she's short the stock market this year. She's bearish. My 8-year-old is an optimist. She's long the S&P 500. She's long the stock market. The great thing is, Chris, at the end of the year, one of them's going to be right, even though none of them had skill. And I am going to take them around and market them as skilled market timers. And I always tell people that because, hey, just because markets are really difficult to time, just because markets are close to efficient, that doesn't mean no one after the fact isn't going to have great returns. Because I just told you one of my daughters is going to be a rock star. And so it's really important to have that healthy dose of skepticism, that when you meet with managers or people selling you investment products, you have to keep in mind that even if no one had skill, 50% of them, just by chance, are going to have great returns. The other 50% are never going to give you a call. And so you'll have this biased lens and you'll say, Pete, I agree with you. Markets are tough and, you know, it's really hard to find a good manager. But, hey, when I look at the average return of every manager that calls me, it's great. And that's what we call a selection bias. You only get to see the winners. That doesn't mean they have skill. And that's something that I try to always pound into people's heads. Not to be violent, but just something that I think is important for people to keep in mind.
Also to suggest that your 8-year-old might be the hot property next year, and then the year after that, maybe your 5-year-old. I mean, it depends. Memories are evidently kind of short because you can just talk about your great success of the last year if you're purely a market timer, which raises a couple of issues, and I hope my question isn't too garbled or big, which are, if you are going to invest in liquid alternatives, what kinds of time horizons should you have, or does that really depend upon the underlying liquid alternative strategy? And secondly, we're in what some people would call a sideways market, not an extended bear, not an extended bull. So it goes up, it goes down. And maybe it'll be the 1980s again one day. But for a market like ours, are liquid alts a good thing to do if you have a good manager?
So on your first point about time horizon, so not only do I think it's hard to time markets, I think it's hard to time strategies. I think there's a lot of academic evidence for that. That doesn't mean there aren't a few people who can do it. I just can't figure out who they are. It's really hard to do that. So I would take a longer term view. I would think about, what are my total portfolio objectives? Does this liquid alt strategy help me achieve those objectives? When I do that thoughtful qualitative and quantitative analysis, understanding we have short history, do I feel comfortable that on a prospective basis, this manager does have special sauce, does have some type of positive differentiated return that I can't access elsewhere? And then once I make that assessment, I would give them a role in my portfolio and not think of it as every quarter, do I get in, do I get out, do I add more money or do I get out? Now, that doesn't mean you sort of sleep at the wheel. You always need to have a process in place to monitor your managers, but I think it's really difficult to time these types of strategies. So I think if you can overcome some of the hurdles I've mentioned earlier in our conversation and you find a great manager because you have a great process for sourcing and underwriting that manager and determining whether they are a great manager, I would give them more of a permanent home subject to that sort of regular monitoring. And it goes back to an actual fact that I was just reading from a fellow U of C Ph.D., Wesley Gray. He was writing an article that looked at the best performing mutual fund of the decade, according to Morningstar, as of 2009. It was called the CGM Focus Fund. It had a 10-year annualized buy and hold return of 18%. Okay? Now here's the punchline. So 18% annualized over 10 years. They then looked at what the actual investors in that fund, a typical investor, earned. And you might say, well, didn't that typical investor earn 18%? The answer is no, because they corrected for the fact that after the fund experienced bad returns, investors withdrew money. And then after the fund experienced awesome returns, then investors put in more money. And because of that return-chasing behavior, instead of earning 18%, the typical investor earned minus 11%. Think about that. And that gets to this whole issue of timing, that it's really hard to do. And I know this is just one simple example, but it's really hard to do. And I think you need to take a longer view once one of your liquid alt managers passes all of those filters.
But before we get to that, this really isn't a liquid alt question, but I've done a lot of these programs, and it's pointed out time and time again what you just described. And what you just described was, this chasing behavior, return chasing behavior, frustrating a good deal, an 18% annual return, and you don't even get it because you're chasing returns out and back in, which is universal, perennial. It must be sourced in some kind of evolutionarily advantageous set of impulses that human beings have, which are not market advantageous, is all I'm trying to say, which is peculiar because as we developed into human beings who invest money in markets, now we're being undermined by whatever it was that kept us alive all these millennia. But my other question, which I'm not sure is a good question, but I'll ask it again, is liquid alternatives, are they potentially more beneficial in a sideways market like today than in, say, a boom market?
Sure. So that's a great question because it's one of those things where I always sort of break it up into two parts. So implicit in that question is that or one might know whether it's going to be a boom market, a sideways market, or a bear market. And going back to my commentary on how hard it is to market time, if we knew the answer to that, we would all be really rich. So I would just, remind people that we just don't know on a go-forward basis. We know historically, looking through a rearview mirror, but on a go-forward basis, whether a market's going to be a boom market, a sideways market, or a bear market. But if you told me, Pete, conditional on being a bear market, for example, would it be better to be in a typical liquid alt versus in the S&P 500? I'm going to say it's better to be in a liquid alt. Now, that doesn't mean the liquid alt is adding any value. That's just a reflection of what we went over before, that a typical liquid alt, like a long-short equity strategy, for example, doesn't have full market exposure. So if markets are going down, like in a bear market, and you don't have full market exposure, you will go down, but just not as much. That, again, demonstrates no skill because we know you could have generated that same dampened negative return at Vanguard. If it's an up market, it goes the other way. In an up market, obviously being in a full beta, full market exposure, all of your money's in the S&P 500 will beat the typical, let's call it liquid alt long short equity strategy, because the long short equity manager doesn't have full market exposure. They would have to have so much special sauce in a bull market to overcome the fact that they're starting from behind with less than full market exposure, less than full beta. And then if it's somewhere in between, like a sideways market, it just depends. It's not clear which one is going to do better. But I think a common thing that I see in the popular press when I'm talking to investors, whether they are less sophisticated investors, more sophisticated investors, is too often people congratulate alternatives, liquid alternatives, when they are doing better on a relative basis against traditional products in a bear market. And then they criticize them when they lag in a bull market, an up market. And I just remind them, guys, that's just a reflection of the fact that a typical liquid alternative does not have full market exposure. You knew that before you made the investment. The fact that they lag in a bull market and they win in a bear market provides no evidence on whether this manager should exist. And so you need to make sure you're always doing those proper, what I would call beta adjustments, so that you can recover the manager's special sauce, the manager's differentiated return, the manager's alpha. Hopefully it's positive. Hopefully it's consistent. Hopefully it's meaningful. That's what investors need to be doing.
Well, Pete Hecht, I can't think of a better place to stop and maybe even pick up on that thought on a later program if that's in the cards for us both. Thank you very much for being on the program.
Well, thank you for having me.
This was Pete Hecht of Evanston Capital Management. I am Christopher Cahill. Accredited Investor Markets Radio is produced by Stephanie Straight and is soon to be rebranded Financial Poise Radio. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.